Hey, welcome to this week's video. In this week's video, we're going to talk about the short-term rental tax loophole, which is a way to reduce taxes on your income from being a short-term rental investor. In this video, we'll break down the basics of how to qualify for this short-term rental tax loophole and how you can apply it to be able to save thousands possibly in taxes. So let's get to work. The year that Top Gun was released, Oprah Winfrey Show was launched, Ferris Bueller's Day Off was a popular movie, and Haley's Comet was also very popular. But the most popular thing, actually not, but the big thing that did occur in 1986 was the Tax Reform Act of 1986. Prior to that date, if you had W-2 income, such as you were a doctor or you're a lawyer, you had business income that you materially participated in, and you had a rental activity, you could actually take rental losses from that rental activity and offset that against your W-2 or business income. The Tax Reform Act took that away by saying all rental activities are considered now passive activities. And what it did is it created two buckets of income, a non-passive and a passive income. So what's the difference between passive and non-passive income? Well, passive income really is anything where you earn money that you didn't trade your time for that money. So like investments, or it could be rental properties, maybe where you have a property management company that is managing that activity and you're not materially participating in that activity. Non-passive income, on the other hand, is income that you are trading your time for income, such as a business that you run or W-2 income. So the question then is, what's the big deal, right? Well, passive income, you can only take losses from that activity up to the income amount. Whereas in non-passive activity, you can actually take any losses that you incur and offset that against income. And in some cases, it could be in excess of that income. So the challenge would be is how do I take this rental activity that I have and turn that into non-passive income to offset my other income and reduce my taxes like I used to be able to do prior to 1986. So let me give you an example. Let's say that you had income of 200,000 that comprised of your W-2 income and your business income, and your tax was around $35,000. Let's say that you also have a rental property that generated a loss due to non-cash items like depreciation expense or cost segregation expenses, and that was $40,000. Well, if you remember, you can't now take that loss against your non-passive income, and thus you're still paying $35,000 in taxes. But if you're able to take that rental activity loss and offset that against your non-passive income, you now have a savings of almost $9,000. But if you actually take that $9,000 and you put it back into your business, and over 10 years, you earn a rate of 7%, well, now that $9,000 savings turns into a little more than $17,000. So you can see how powerful it is in order to be able to take that non-passive income, reduce it by that passive income. So now let me take you to the mid-1990s, where movies like Pulp Fiction was released, or the debut of Friends Show, or the unfortunate loss of Kurt Cobain happened. During the mid-1990s, another tax reform came, and that came in the form of an exception because now people that were participating pretty much as their job day to day were saying that, hey, I have this rental activity that I do as well, but that is considered passive, even though this is my main source of income that I incur. So if you're like, for example, working as a developer, or you had construction, where let's say that you're developing 40 properties and then you have another 30 properties that you're actually renting. Those other ones, the 40 properties that you're selling, well, those 40 properties would be a business, and those 30 properties are a business, but it's considered passive because it is a rental activity. So in order to fix that, Congress came up with these rules called real estate professional. And to qualify as a real estate professional, then you would be able to take that rental activity and treat it as non-passive activity. And thus, if you had some losses from rental, you could now offset it against your non-passive income. And thus, the exception was born in the mid 1990s to allow for that. Okay, so let's talk about what really is a real estate professional and how do you qualify for it. Well, basically, in a nutshell, you're spending the majority of your working hours in a real trade or business in which you materially participate in. And the rules basically are complicated, but in a nutshell, what you need to do is spend the majority of your time in real trade, property, or business that you materially participate in, which we'll talk a little bit about material participation later on in the video. And you must have at least 750 hours in that real trade or business in which you materially participate. Now, what does that mean once you do qualify as a real estate professional? Well, as you remember, I talked about earlier that now you can take that rental activity and treat it as a non-passive activity and thus offset it if you had any losses against your W-2 or business income, basically your non-passive income. And that actually helped out quite a bit. However, you had these other investors that prior to 1986 were able to take those rental activities and offset their non-passive income. That got taken away. And now that still left them with not being able to utilize that passive income against non-passive loss. However, there is an exception, and that is called the short-term rental tax loophole. If you qualified for this loophole, which I have on the screen, you will be able to treat that rental activity as not a rental activity that is defined in the tax code. So in this example that I gave earlier, you would be able to now, if you qualified as a short-term rental investor, take that activity and make it a non-passive activity. So under the short-term rental tax loophole, if you're able to have a rental activity in which the activity is rented for less than, on average, 7 days or less, or 30 days or less, and you provide significant personal services, which think like a hotel where you're providing daily cleaning or other services that you wouldn't normally provide with your short-term rental, then you could possibly treat that short-term rental as non-passive activity because under the tax code, it doesn't qualify for a rental activity because the tax code provides this exception that I have here on the screen. So now once you either are a real estate professional or you qualify for this short-term rental, now think like short-term rentals like Airbnbs or VBROs, then you can get that activity to be non-passive, but you have to show that you materially participate. Remember, I talked about that earlier. You materially participate in that rental activity or trade or business and rental activities. And what does that mean? Well, basically here, the top three things that I have on this slide represent almost 90% of what most people will qualify and be considered to materially participate in that property. So you have to work at least 500 hours in that business, or you did substantially all the work, or you worked at least 100 hours or more and nobody else worked anything more than you did. And it's in this test, it's not each one you have to meet, it's either or. So if think about, for example, if you have a property management company that's doing all the work pretty much, and you do a little bit of work, but you don't have significant hours in that, then you wouldn't materially participate. But if you're doing all the bookings, you're doing all the cleanings, you're doing all the marketing, and you work more than anyone else in that rental activity, then you would meet the material participation. But bottom line is, once you meet the material participation and you meet that short-term period that I mentioned earlier of 7 days or less, or 30 days or less with substantial services, then you can now treat that activity as a short-term rental activity and you escape the passive activity rules that I mentioned earlier, and you don't need to be a real estate professional and thus you can take any losses that you may have from non-cash activities and now offset that against your non-passive income. And that would mean that you would qualify that people did prior to the 1986 tax reform. Now you would be able to do what they were able to do by utilizing these short-term rental rules. So bottom line is there are ways around the passive income rules such that if you're able to get past those rules, you now have a potential to offset some income and reduce your taxes, just like the example that I mentioned earlier, and be able to save money in taxes and invest that back in your business and save even more money. And so by following these rules and utilizing them, you can accomplish that and be able to put more money into your pocket, which of course is the goal. Also, I'll include a link down below on an ebook we did on the top 10 ways that you can save money in your real estate business starting today. So that's it for this week's video. If you got any value out of it, it'd be awesome if you hit that thumbs up. And if you haven't subscribed, that'd be great to have you as a subscriber. So until next time, I'll catch you on the next one.